So what are the benefits of an FHA multifamily loan? Well, for starters, you can buy up to a 4-unit multifamily apartment building with only 3.5% down. So if your goal is to accumulate 100 units, 1,000 units, if your goal is to get into multifamily investing, this is a great way to get started. Or maybe your goal is just to have a few rentals, paid off over the next 10, 20, 30 years. This is the perfect way to get started. And the great thing about the FHA loan is that, yes, you can buy a 4-unit apartment building, but maybe you don't want to take that on. You can buy a triplex, you can buy a duplex, you can buy a single family house. There's many different types of properties you can actually purchase with this loan. I would always recommend, if you're trying to get into multifamily, usually the more units is the better option. However, I just did a deal with a client where she bought a duplex and it was a steal. It was an underpriced property, whereas some of the 4 units in this market that we were looking at were a little bit overpriced. So you just kind of have to look at the comps as well. The next pro is that it's going to be a better interest rate than an investment rental property loan. So if you go to your lender, and let me know if you need a good lender, I can put you in touch with a few. If you go to your lender and you say, look, I want to buy a rental property, I want to buy a 4-unit apartment building rental property, I'm not going to live there. The interest rate is going to be higher than if you did FHA. FHA does have to be your primary residence. So primary residences, the interest rate is going to be lower because it's less risky to the lender. Rental properties and flips carry a little bit more risk, whereas if someone's living there, the chances of things going south are not as high. So that's why you see with like hard money loans, those interest rates can easily be in the double digits, 10, 12, 15%. Whereas a primary residence loan, you might at this point in the market, you might be looking at like 5 or 6%. The next pro is the down payment. So you only have to put down 3.5%. Now that's the minimum amount. So you can obviously put, there's people that you can put down 50% if you want. However, it's at most loans, it's hard to find any other type of loan where you don't have to put down more than 5 or 10%. Even 5% is a little bit low. If you're a VA buyer, actually the VA loan, you don't have to put any percent down. However, outside of VA and FHA, it's going to be extremely difficult to find any type of loan with a down payment that low. And what's also cool with that 3.5% down, if that's the amount you decide to put down, you can get that in the form of gift funds. Now, any type of gift funds or any type of financial decisions that you're doing, always run them by your lender, because every lender is going to have different policies, different ways of working, and they need to find out where the money's coming from. However, you're allowed to get gift funds for the down payment. So if you have a letter from a family or friend saying, hey, we're going to give you, 3.5% down, 20K, 30K, whatever it is, the lender will be okay with that. Show it to them and they'll approve it. So you can basically bring like zero to the table. Now there is closing costs. So most closing costs on a home, it's probably safe to say about 3%. In some cases, it might be a little higher. In some cases, it might be a lot lower. But that's a good rule of thumb. So when you're buying your first apartment building, you need to factor in, okay, it's going to be the 3.5% down payment plus another 3% in closing costs. However, what's another great thing about the FHA multifamily is that you can get up to 6% in seller credit. Let's say the property is $500,000. You can offer the seller $500K and then say, give me a 6%. 6% actually might be kind of high. You might actually be getting money, which, you'd obviously have to check with your lender as far as that goes, because there is a limit. You're typically not allowed to get any money at closing. So you could tell the seller, hey, we want this amount of credit, and it would basically cover your closing costs. And then you can also say, like, any unused amount in credit shall go towards an equal reduction in the sales price. That could protect yourself a little bit. You could essentially have zero, bring zero to the table. If you got a gift fund from a friend or family member, plus you got the seller to give you, like, let's say a 3 or 4 or 5% seller credit, you wouldn't have to bring anything to the table. Another great thing about FHA multifamily is that it's easier to qualify than a conventional loan. So FHA only requires, I think it's like 580. Now, every lender is going to have their own policies. So what the FHA says and then versus what each lender says is going to be a little bit different. So most lenders will typically want to see like 620 credit scores. But according to the FHA multifamily, you can qualify with as little as a 580, maybe even a little bit lower than that. So that's if your credit score is kind of low, you might want to ask a few lenders, because each one is going to have different policies and they might be able to get you approved with a low credit score. If you're going the conventional financing route, your credit scores would likely easily have to be in probably the mid 600s. The next pro is that you can use the rent from the other residents to help you qualify for the loan. So when I bought my FHA multifamily, 3 units were occupied, which this is like the ideal scenario. If you have 3 units occupied at near market rent and 1 unit vacant. I had the 1 unit vacant. The other 3 residents were paying, I think it was about $3,600 per month, about $1,200 each. I think it may be a little bit lower than that, but let's just say $3,600. And then what the lender will do, they'll take 75% of that rental income and then apply that towards helping you qualify, with your DTI and monthly payment and things like that. So if you just have a duplex, that can, if you have a duplex and someone else is living in the other unit, that can still help you, probably quite significantly qualify. That's an extra $1,000 per month that you're getting. They'll use 75% of that. But that's another great thing about FHA multifamily. The next thing to know is that you can actually use FHA multifamily more than once. And I'll kind of explain a little bit. So let's say you use your FHA multifamily, you get a pretty good deal, maybe you fix the property up a little bit, maybe the values go up a little bit, and then after a few years you have, let's say 10 or even 20 or 25% equity in the property. At that point, lenders really need about 25% equity for like investment properties, 20 to 25% equity. So what you could do is you could refinance that into a conventional rental property loan. And once you refinance that, so long as you have enough equity into that rental property loan, then you'll have your FHA multifamily eligibility once again. And then you could rinse and repeat the process, and you could go find another FHA multifamily, and that could be your whole business model. If you did that for like 10 years straight, I mean, you'd have a lot of you'd be the FHA multifamily expert, and you'd probably be making videos like this. The next pro is called the Streamline refinance. So with FHA loans, they have a refinance program which is very easy to refinance. Now you're still going to be in the FHA, so it's not like you can have that do two FHAs at the same time. However, and this is something I did, if you were to refinance, typically it's a lot more paperwork and it's a lot more involved. With an FHA refinance, it's literally called the FHA Streamline refinance, and it's actually very streamlined. Sometimes you hear these loan companies and these different real estate brokerages, and it's like trustworthy this, honesty that, fast this, guaranteed that, and then it's like the opposite of that. With the FHA Streamline refinance, it is actually streamlined. I don't even think they check your credit score. I don't even think they care if you have a job. It's basically like, will your payment be lower? And are you still making your payments is pretty much the qualifications. Always talk to your lender, but it's a very easy process and you can get your payment down a little bit. The next pro is that FHA loans are assumable. So you could reach out to people that have closed FHA loans in like the last 10 years. Your agent can just do a search of multifamily and just see what type of loan they did. It would require a little bit of research, but if you're serious about buying, they could probably pretty easily pull that up. And maybe you reach out to those people and see if they're willing to sell you the property, and then maybe you assume the loan. Additionally, when you go to sell your property, your FHA property, if you do decide to sell, maybe you just hold on to it for 30 years, and that's your retirement strategy. Having a small multifamily cash flowing for you. But when you do go to sell it, you can offer, hey, I have this great rate, and the future buyer can assume it. Now you do still have to pay the difference between, the mortgage after, a few years, 10, 20 years might be a lot lower than what the sales price would be. So then the buyer would have to bring the difference between the mortgage and the sales price, which might be, $100,000. But there's some people that maybe they're over leveraged, or maybe there's just different scenarios where they need to get out of the property quickly, and you can assume that property. Real quick, 10 seconds. If you're looking to buy a small multifamily apartment building with an FHA, reach out to me. I'm in the Washington, D.C. market, so I can help you out if you're in this market. But if you're in a different state or city, I also have agents nationwide that I can put you in touch with that would do a great job. Let's talk about the cons now. So con number one is that it has to be your primary residence. You have to live there for at least a year. It has to be your intention to live in this property for a year. So because FHA doesn't want people just using it completely as a rental property. After 1 year, you're allowed to move out and you can rent it out, but they're becoming more and more strict with people, making sure you live there for a year, and then it can become your rental property if you want it to. The next con is that the FHA appraisal process can be a little bit stricter. And I think honestly people make too big of a deal out of this. It's going to be stricter than a conventional loan, but it's really not going to be it's not going to be the most difficult appraisal you've ever done. The property that I purchased, it needed a little bit of work, but it was in relatively good condition. The FHA just doesn't want to see broken windows, bars on windows, peeling paint, roof caved in. They don't want to see things that are egregiously wrong with the property. It has to be a livable property. They'll be a little bit more strict than conventional, but you can also, if they have conditions to fix before closing, oftentimes you can get those fixed. We had one where the bars had to be removed from the windows. So before closing, we had our handyman go over, he removed the bars, we sent a photo, or I think the appraiser actually went back there, confirmed that the bars were removed, and then they were good to go. And so this property, it actually needed some work in other parts of the house, but it was technically livable. It wasn't, it had appliances, it had doors, it had windows. There was nothing egregiously wrong with it. The next con is the mortgage insurance premium. So anytime you're doing a loan, typically with less than 20% down, it's going to be a riskier loan. So then the bank and the lender wants to have some type of mortgage insurance on it in case the buyer were to default. And this is especially true with FHA, since a lot of buyers are only putting 3.5% down, which is a very small amount. So they're going to have the mortgage insurance premium. You have to pay this every single month. I think mine is about $300, $400 per month on a 500K property. And they actually recently just lowered it. However, it's still going to be probably likely several $100s that you're going to pay every single month. And you actually can't get rid of it. So with most properties, once you have 20% equity, if you had a conventional loan and you had only put down, let's say 5%, you can get an appraisal done again. And if the appraiser says that there's 20% equity in that property by looking at the comps, then you can get your mortgage insurance removed, because now at this point it's not as risky of a loan. However, with an FHA loan, even if you have 20% equity, you still have to pay the mortgage insurance premium. One thing you can do, I think if you put down 10% originally instead of 3.5%, then after 11 years, if you have the 20% equity, you can get it removed. Kind of odd numbers, but yeah, you're kind of stuck with that. The next con is that depending on where you live, like there's some cities like Baltimore or DC and different places where there's a good amount of multifamily, but depending on where you live, there might not be a ton of options when it comes to multifamily, like small multifamily properties. So you might have to go to like a city close by and live there for a year. The best way to find it, like obviously you should set up an MLS search, and you should look for properties that are listed as well as ones that have been removed, like canceled, withdrawn, temporarily off market, that type of thing. You can get your agent to do that. And I also have a video on how to find off-market multifamily using PropStream. So that is a great way. That's how I found tons of, probably like at least my last 5 multifamily deals was marketing to off-market multifamily sellers. And PropStream is a very easy and simple way to do that. So check that video out as well, after this video, of course. The next con is that the loan limits for FHA are not going to be as high as conventional. And that being said though, the loan limits are still pretty high. If you look at the FHA loan limits for different cities, like in the expensive areas, obviously they're higher. Like San Francisco, I think you can go to like 1.4, 1.5, maybe even a lot higher than that. But each city is going to have different loan limits. If you're in Iowa, it might only be like 700K or 800K. And then if you're in New York City, San Fran, DC, it's going to be in the, potentially multi-million-dollar range. But it's going to be a little bit lower than conventional. The next con is that you're going to be living with your tenants. So depending on if you have good tenants, bad tenants, they might be knocking on your door. Now you should set up some type of parameters where you say, this is how, if you have a maintenance request, this is how it's done. And maybe even hire a third-party management company just so they don't come to you and knock on your door all the time. Even if they do, it's like you just fix the issue and then there shouldn't be a ton of problems. You get the problem fixed and then they don't complain as much. And you set up systems and procedures where you shouldn't be having a ton of complaints. Now, if you were living in like a 100-unit building, that would probably be a headache if you had 100 different people with different problems and things like that. But if it's only like 3 or 4 people, it's basically just like having a few roommates that live upstairs or downstairs, and maybe the hallway light goes out or different things like that. It's usually not going to be drastic issues. And even if it is, they're going to be manageable because it's only going to be at a maximum, 3 other units there. The next con is that if you're buying like a 3 or 4 unit, you're going to have more cash reserves. You're going to have to show the lender that you have more cash reserves than if you're just buying a single family house or a duplex. So you're going to just have to have a few more months of savings. Not a huge problem, but it's definitely a small con. FHA loans can also take a little bit longer, and that's why it's good to have like a local lender, or at least a lender that's responsive, that has a cell phone, not a 1-800 number with a huge bank. And I can put you in touch with my lender. But you want someone that can handle situations that come up. They'll have to look at rent rolls and things like that. So there's a little bit more moving pieces than a standard loan, and it can take a little bit longer. But a good FHA lender can still get the deal closed in 30 days, maybe even less than that. But it might be a little bit longer than conventional. The next con is that if you're in a bidding war, it's going to be a little bit tougher to win with an FHA. And the reason for that is FHA has a reputation of taking a little bit longer. The appraiser is a little bit stricter when it comes to property requirements, and you're also putting less down. So most of the time sellers and listing agents want to go with like the most financially qualified person. And if someone's putting down like 20% and then you see an FHA property and it says closing in like 45 days, we're only putting down 3.5%, they're probably going to go more with the conventional. But again, that's why I love off-market deals. So watch this PropStream video right here. And if you're looking to buy an FHA multifamily nationwide, reach out to me as well. Or if you have any questions, I'd love to help.